Hey there. Do you remember the feeling of getting that big fat tax refund check? It felt like a yearly bonus from the government. A chance to finally buy that new phone, pay off a credit card, maybe even take a small vacation. You'd file your taxes, wait a few weeks, and then, boom, money in the account. Almost like a reward for surviving another year. Your parents probably got thousands back. Maybe your older siblings did too. But you're getting $200 or $150. Or worse, you're getting a letter saying you actually owe money. And the question eating at you is, what changed? You didn't get a massive raise. You're not living some lavish lifestyle. You're doing everything right. So why does tax season feel like a punishment now instead of a reward? Here's the thing most people don't want to hear. Your refund isn't shrinking because you're doing something wrong. It's shrinking because the rules of the tax game have been quietly rewritten behind your back, and nobody bothered to send you a memo. In this video, we're going to break down exactly why the IRS changed the math, how pandemic-era gifts were taken back without fanfare, why your side hustle is now working against you, and why a smaller refund might actually be a sign of a system designed to squeeze the middle class. Let's get into it. Quick disclaimer. This video is for educational purposes only and is not professional tax advice. For your specific situation, always consult a qualified tax professional. Let's start with the most fundamental shift, one that happened in 2020 and that most people still don't fully understand. First, we need to bust a myth. That tax refund you love so much, it was never free money, it was never a bonus. It was your money the entire time. Money you overpaid to the government throughout the year, sitting in their account, earning them interest, not you, while you waited to get it back in a lump sum come April. Think of it like going to a restaurant, handing the waiter $60 for a $45 meal, and then feeling excited when they bring back your $15 change. The change was always yours. You just let them hold it all night. For decades, that's essentially what Americans were doing with their taxes, and most people were fine with it because at least you got a lump sum at the end of the year, even if it was your own money. But in 2020, the IRS overhauled the W-4 form. If you haven't looked at a W-4 recently, it's the form you fill out when you start a new job, the one that tells your employer how much tax to withhold from each paycheck. The old W-4 had a system called allowances. The more allowances you claimed, the less tax was withheld, and the smaller your refund, or the bigger your bill, at the end of the year. It was confusing, outdated, and wildly inaccurate for most modern working situations. So the IRS scrapped it. The new W-4 is designed to be far more precise. It asks about your other income, your deductions, your dependents, and it tries to withhold as close to your exact tax liability as possible. The result? Instead of overpaying all year and getting a refund, you're now paying closer to the right amount every paycheck, which sounds fair. And technically it is. More money in your weekly paycheck is objectively better than giving the government an interest-free loan. But here's the problem. Most people never see that extra $30 or $40 per paycheck as a benefit. It quietly disappears into everyday spending, groceries, gas, subscriptions, eroded away by inflation before you even notice it. And then April comes, and there's no pot of gold waiting at the end of the rainbow. The refund is gone, not because you were robbed, but because the system got more accurate. The emotional reward of a lump sum disappeared, even though financially nothing actually got worse, at least not from this change alone. Because other changes made things genuinely worse. Cast your mind back to 2021. The world was still deep in the pandemic. The government was trying to prop up households and keep the economy from collapsing entirely. And as part of that effort, Congress passed one of the most significant expansions of family tax benefits in decades. The child tax credit, which previously gave families $2,000 per child, was temporarily boosted to $3,600 for children under 6 and $3,000 for children between 6 and 17. On top of that, They paid half of it out in advance, in monthly installments, from July through December 2021. For millions of families, that was $250 to $300 extra per child every single month. It was transformative. It cut child poverty nearly in half during the months it was in effect. And then, it expired. Congress didn't renew it. The credit dropped back down to $2,000. The monthly payments stopped. And families who had been relying on that expanded credit suddenly found themselves looking at a tax return that was thousands of dollars smaller than the year before, with no explanation, no warning, no front-page headlines. If you have 2 kids, that's a $200 difference compared to what you were getting just a couple of years ago. That's not a rounding error. That's a significant hit to your household finances, one that arrived quietly, without fanfare, wrapped in the language of policy expiration. Now here's where it gets political, but it's important context, so stay with me. While those family tax credits were allowed to expire, many of the corporate tax benefits from the 2017 Tax Cuts and Jobs Act remained firmly in place. Large businesses continued to benefit from a reduced corporate tax rate of 21%, down from 35%. Various deductions and accelerated depreciation benefits were preserved or extended. The credits designed for working families, gone. The brakes designed for corporations, still running. Whether you think that's fair or not, the impact is real. Families who were counting on that expanded child tax credit got a significant, invisible pay cut. And most of them didn't even understand why their refund looked so different. That's the ghost of pandemic relief. It gave you something, let you get used to it, and then took it back without much of an explanation. Now let's talk about something that's affecting tens of millions of people and quietly destroying tax refunds across the board: the side hustle. We live in the gig economy. Uber drivers, DoorDash couriers, Etsy sellers, freelancers, people reselling sneakers, flipping furniture on Facebook Marketplace, selling old clothes on Poshmark, doing odd jobs through TaskRabbit. Side income is everywhere. And for a long time, a lot of that income flew under the radar, not because people were trying to cheat, but because the reporting thresholds were high enough that small amounts simply weren't being tracked by third-party platforms. That's changing fast. The IRS has been systematically lowering the 1099K reporting threshold. That's the form payment platforms like PayPal, Venmo, Cash App, and Etsy are required to send you and the IRS when you receive a certain amount of money. The old threshold was $20,000 and over 200 transactions. The new rules are pushing that down dramatically toward as low as $600. The IRS is essentially watching your Venmo now. What does that mean in practice? If you made $2,000 selling old clothes this year, or $3,000 doing freelance design work on the side, that income is now appearing on a tax form. And if you didn't set aside money for it throughout the year, no taxes were withheld. Here's how that destroys your refund. Think of your tax situation like a bucket. Your main job fills that bucket with withholdings throughout the year. At tax time, if you overfilled the bucket, you get the overflow back as a refund. But your side hustle has a hole in the bucket. That untaxed income drains the bucket. And if the drain is big enough, your refund doesn't just shrink, it disappears entirely. You might even owe money. And here's the thing that catches people completely off guard. They feel like they made more money this year. They did make more money, but they owe more tax. And instead of a refund, they get a bill. The side hustle trap isn't about working hard, it's about not knowing the rules before you get hit by them. The last piece of the puzzle is one of those slow, invisible forces that you almost never hear about, but that quietly erodes your financial position every single year. It's called bracket creep. Here's how it works. Say you earn $60,000 this year. Your boss gives you a 4% raise to keep up with inflation, which has been running hot. Now you're earning $62,400. On paper, you got a raise. But in real terms, in terms of what you can actually buy, Your purchasing power is roughly the same because inflation ate the difference. Here's the problem. The tax system doesn't see it that way. It sees $62,400 and it may push you into the next tax bracket. Or it may reduce your eligibility for certain deductions and credits that phase out at higher incomes. The government is treating you like you got richer, even though in real terms you didn't. Now, to be fair, the IRS does adjust tax brackets annually for inflation, and they've been doing that. But the adjustments don't always keep perfect pace with real-world inflation, particularly when inflation spikes suddenly, as it did in 2022 and 2023. And other thresholds, like phase-outs for certain credits, don't always move at the same pace. The cumulative effect. Over years and decades, a growing number of middle-class workers quietly end up paying a higher effective tax rate than they realize. And here's a look ahead that you need to be aware of. Many of the individual tax cuts from the 2017 Tax Cuts and Jobs Act, the ones that lowered rates and doubled the standard deduction, are set to expire at the end of 2025. That means 2026 could look very different for millions of taxpayers. Rates could go up, deductions could shrink, refunds could get even smaller, or tax bills could get significantly larger, especially for the middle class. That conversation is happening in Washington right now, and wherever it lands, you should be paying attention. So let's bring this all together. Your tax refund isn't shrinking by accident. It's shrinking because of a combination of deliberate policy changes, a redesigned W-4 built for accuracy, the expiration of pandemic-era credits, tighter surveillance of gig and side income, and the slow creep of inflation pushing people into higher effective tax brackets. Some of these changes are neutral, some are genuinely unfair, but all of them are real, and all of them affect your bottom line. So what can you actually do? Number 1. Check your withholding mid-year. Use the IRS withholding estimator online to see whether you're on track or whether you're heading for a surprise in April. It takes 20 minutes and can save you a lot of stress. Number 2. If you have a side hustle, set aside roughly 25 to 30% of every dollar you earn from it. Don't spend it. Treat it like it was never yours to begin with. Number 3. Watch the 2025 tax cliff. Understand what expires, what might be extended, and how it affects your specific situation. An hour of research now is worth a lot more than a surprise tax bill later. The bottom line is this. If the government isn't going to give you a bonus, you have to learn how to keep more of your own money in the first place. That means understanding the rules, even when they keep changing them. If you found this video helpful, hit the like button and subscribe for more deep dives into the money games they don't want you to understand. See you in the next one.